Hi there. Welcome back to another edition of Premier Investments and Wealth Management Financial Program. My name is Doug Wagner, and before I introduce the gentleman around the table with me, I want to encourage you to go to premieriwm.com. There, click Get Started, and you will be asked a few questions, and my friends at Premier Investments and Wealth Management will provide a one-page Premier Vision document. You're saying, what would I use that for? Well, it's for retirement. Do you know if you're ready for retirement? Do you know what it takes to get ready for retirement? That's what the professionals at Premier Investments and Wealth Management can do for you, is help you wrap your arms around it. Get a hold of this because it's not easy, okay? Most Americans don't know if they can retire. You could be one of those special ones by going to premieriwm.com. Get that one-page Premier Vision document and a free meeting with my friends at Premier. They'll come to you. You can come to them. They'll do it virtually. They'll even give that document over to you. I encourage you to do this because you deserve the best retirement ever for you and your family. PremierIWM.com. Make your appointment there by clicking on Get Started, or you can even call 800-383-6590. Premier Investments and Wealth Management named to Forbes 2025 Best in State Wealth Management Team. Introducing now to my right, the big kahuna, Roger Abel. Coming to you first this time.
I was taken back. I was caught off guard, but awesome. Thank you. I enjoy being first.
Thought I'd do something a little different. It's like this. It's the big kahuna. He's with his fin like that.
When you told me I'm first, you know what it reminds me of? Ricky Bobby. If you're not first, you're last.
Exactly. Look at that. Hey, speaking of which, if you're born with a onesie on, you don't have to put a onesie on. Jonas Everett is next up in line.
How do I top the big kahuna now? I'm getting a complex over here. Nobody can top the big kahuna.
He's the bumblebee tuna. That's what he is, right?
Okay, I'll take it.
And then right next to me, Elias Randel. Elias, how are you? He's vice president and also the new sheriff in town here at Premier Investments and Wealth Management. Before I get there, that guy's got 30 plus years of experience in the investment industry.
Good for him.
And
That's quite the accomplishment.
Yeah. And then over there, he's the president of Premier Investments and Wealth Management. He's an accredited investment fiduciary. He's a certified exit planning advisor and over 22 years of experience. Here you're working toward that, one of those designations too. Is that right?
Yes, I will also have the Certified Exit Planning Advisor designation in the next 9 days.
Awesome.
I don't remember what day I'm taking the test,
Good
but I'm
for
prepping
you.
for it right now.
Congratulations. See, they are constantly prepping and improving on what they can do so that they can help you, their customers, their clients, many times their friends at Premier Investments and Wealth Management, premieriwm.com. Roger, let's get back on track. I apologize. It just sort of was chaotic at the opening, but I was feeling it. Sonia asked, I turned 73 last year. She doesn't look it either. She forgot to take an RMD from her retirement account. What should she do now? What would you say to Sonia, Roger?
It's okay.
Oh,
Don't panic.
okay.
There are steps you can take to fix this, and you're not the first person to miss a required distribution. Let's backtrack a little bit and talk about what a required minimum distribution is. It's only mentioned in our industry, so most people don't know what it is. In fact, 62% of the people don't even know what it is or aware that they have to take it. All the required minimum distribution is, it's the age in which the U.S. government would like you to take some money out so they could receive a few dollars in tax finally, since you've deferred it for a long period of time. For investors that manage their own investments, the RMD brings risk into missing it. Most custodians provide, at the end of the year, the dollar amount you must take to satisfy this. So one of the things we do at Premier, we have an RMD list that we're auditing all the time to make sure people have taken their distributions. It typically happens at this time of year.
Right.
Most people like to take the required minimum distribution at the end of the year.
Like third, fourth quarter.
Yeah, they have an idea of, one, how much money they've made. They may want to make a charitable gift with it if they've made more money than they thought. One of the things that works really well for people who are taking required distributions is to set these up to automatically happen.
Okay.
All the custodians, for the most part, that I'm aware of, would allow you to go in, set up an automatic RMD. They calculate it. They send you the check. You can't miss it. All right.
Okay.
One of the reasons it's important to take the RMD, if you miss it, it's a 25% penalty.
Ooh.
That's if you miss it and don't fix it. 'Cause
Okay.
you can fix it.
Yeah.
Okay. Which you said, oh, it used to be a 50% penalty, Doug.
Oh.
That changed under the Secure Act 2.0. So let me talk about the steps for Sonia directly, what Sonia needs to do.
Mm-hmm.
All right. First, take the required distribution immediately. You're going to have 2 to take this year. Take them separately so that there's a documentation of taking the missed required distribution.
Okay.
Second, you're going to file Form 5329 with the IRS. That's an explanation form, and put a cover letter on it asking for a waiver.
Dear sirs.
Dear sir, please, I forgot or didn't know.
I'm so sorry.
And you make a clear request for waiver of the penalty. 2, let them know what tax year the RMD was missed. 3, the reason the distribution was missed. Just tell them, I didn't know. Tell them why. 4, the date you discovered the error. The 5th step, the date the distribution was taken, and then proof that you've made and corrected the mistakes, such as copies of financial statements. The IRS will likely waive or reduce the penalty. We have had this happen to people typically on accounts that aren't here with us. In fact, I had an individual come in who is a customer, I think this is about a month ago, and she had a 403B. So that's through a separate account, and she left it there. It was a small account.
Yeah.
It's like $20,000. She missed an RMD, so then she took it for the next year, but then she forgot to take it that year because she thought she already satisfied it.
Okay.
She's been one behind.
Right.
So I walked her through these steps. She got this waived, but it really goes to once you get into retirement, the more simplification you can do, the better. Could have easily said, hey, let's commingle this with an IRA and roll it over. Get down to one RMD, but she's taking one here, and now she has to take one there.
Yeah.
So simplification to the problem. So the good news for Sonia, there are steps you can take to fix it. Just tackle it right away. I laid out the 5 steps. Sonia, if you need help, call our office. We're happy to get you the information that you need. But it really goes to why working with a professional, especially later in life, as people start to lose capacity at some point. Just
Right.
the desire to figure this stuff out, the overall mental aptitude. This is the time you should have a professional help you out to get you through all of these different changes that are going to happen in retirement.
I love that stat, Roger, that you said 62% of Americans didn't realize what an RMD was. I'm finding that I'm talking to a lot of my customers that are nearing age 70, and they still think that they have to take their required minimum distribution at 70 and a half. In the Secure Act, it's 73 now.
They've made it complicated. It's 73, but if you turn 75 after 2032, it's 75. Let's just come up with an age, call it good, move on down the road.
Or
Like,
just
can't
get a
it be
financial
one?
advisor, get a wealth advisor. They can help you handle these sorts of things. I think what you said, Roger, was so apt is that after a while, you lose bandwidth. You have other things that you're doing in life, especially if you're retired. You got grandkids maybe, you're traveling, you're doing other things. Your mind's full of a whole lot of other stuff. Let a financial professional be the one that helps you manage this portion. At premieriwm.com, they can and will do that for you. You can make your appointment online. Again, premieriwm.com, or call 800-383-6590. Premier Investments in Wealth Management named a Forbes 2025 Best in-State Wealth Management Team. Let's head over to Elias with a question from Josh, who said, heard you guys talk about the bucket strategy for income in retirement, but when exactly do I implement that? Before retirement, the day of retirement, 5 days after retirement, 2 weeks after? I'm 61. I'm thinking of retiring next year. I'm trying to figure out what to do and when to do it. What do you say to somebody like Josh who's counting down the days until retirement there, Jonas? Elias, sorry about that. I apologize.
I say ask Elias.
Josh, you are correct. You've heard us talk about the bucket strategy a lot. It's something we not only talk about a lot, we do a lot. I think I could probably do it in my sleep at this point. This is a great question, and what he's really getting at is timing of when to prepare the bucket strategy. So I want to talk about a couple things. One, what does the bucket strategy do? And then how does it work? And then a timeline to think about implementation. The bucket strategy is really a roadmap that does 5 things: clarifies your income needs, defines the withdrawal strategy, segments the accounts and assigns responsibility by time horizon, coordinates taxes, and then ongoing way to rebalance and adjust your portfolio. So here's what the buckets are. Bucket 1, we call our short-term bucket or the liquid bucket. We view it as money that you're going to spend in the next 1 to 3 years. And the reason for that, the longest bear market ever was nearly 3 years long, happened in the Great Depression. So the money you're going to spend from today to 3 years out, it's a good idea to have in short-term investments, cash and cash alternatives. I can do a quick answer for Josh, and we'll talk about the next 2 buckets. He's retiring within the next year. I think 12 to 18 months is a very appropriate time to start analyzing how much cash am I going to need in my liquid bucket. So yesterday or today, Josh, for your short answer.
Well,
Start
especially
working
because
on
markets are at all-time highs. We're all-time highs.
Just another great reason to review and start preparing your cash.
100%.
That's a great point, because it's also a little bit of, what are you waiting for? We've had great returns. Let's take some chips off the table.
If he doesn't do it, he runs the risk of waiting a year. Now the market has a 20% correction. What's he going to do then?
He's going to think about staying at work.
That's exactly what will happen.
And what I like to say, everything's better in a bull market.
I like that.
That's a very good saying, Jonas.
So let's get your bucket strategy.
Bucket 2 is the midterm bucket. We really view it as money you're going to spend 4, 5, and 6 years from today. It's really designed for moderate growth and replenishing bucket 1. So if you have dividends or interest being paid in bucket 2 and you're taking money out, those interest and dividends will not be reinvested. They're going to go back to bucket 1 and refill that short-term liquid bucket. And then we have bucket 3, which is the long-term growth bucket. That's money we view you will be spending at least 6 years or more from today. And this is really the fun bucket, the exciting bucket. This is your growth. This is your stock market strategy, your long-term growth. Here's what this type of strategy does for people. 1, when the market's volatile, you don't have to worry about your spending money today. When you need to rebalance, you've already decided, when I rebalance, I have buckets to fill up. Bucket 3 fills up bucket 2. Bucket 2 fills up bucket 1. Pretty simple, right?
Yeah.
So built-in way to deal with fluctuations, built-in way to know where your money's going when you rebalance. So for Josh, he's within the timeline that I'm looking at. Let's build some cash now. And you can either reallocate gradually or all at once. If I'm 60, going to retire 61, I'm looking at my performance the last couple of years. I'm going to raise the cash. That's what I'm going to do at this time with where the market is.
I have one
that
thing
could change depending on environment.
One thing to add to that.
Please do.
It's crucial that he figures out what his risk capacity is, because it's almost impossible to implement that without knowing how much risk do you have to take to be successful. Because that's how you would allocate the bucket. That's part of how you allocate the buckets outside of that cash bucket. That's the one thing that you can't do that bucket strategy in an optimal manner without understanding your risk capacity. And then the risk capacity and buckets ultimately keep you on track from making bad investor mistakes.
Excellent point. Your risk capacity will define the allocation. Bucket strategy is going to manage the cash flow, essentially. So, but those two things married together, as Roger mentioned, that's going to set you up for a very successful retirement.
If you go to premieriwm.com, there is a downloadable portfolio that you can grab a hold of. It's called 10 Critical Steps to Take Before Retirement. And it will, you read through that. I think it's going to encourage you to get in touch with one of my friends, Premier Investments and Wealth Management, in order to make an appointment so you can get your personalized strategy. This is not cookie cutter stuff, okay? You're talking about bucket strategies in 1 to 3 years, and then 4 to 6 years, and 5 to 10 years. It's all dependent on you. Everything from how you invest to the timeline for investing to what you're investing for. Premier Investments and Wealth Management website at premieriwm.com. Click Get Started. Answer a few questions. They will provide for you a one-page Premier Vision document, and they will give you a free meeting to go over it with them, and you can keep that document as well. 800-383-6590 is the telephone number to call so that you can make your appointment, as well as doing that online. Premier Investments and Wealth Management named a 2025 Forbes Best in State Wealth Management Team. Now I get to go and talk to Jonas.
Hi, Doug.
Hi there. Sorry about that. I sort of skipped through, but Yolanda has this question for you. It says, my husband and I don't have kids. We plan on spending all of our assets in retirement. How do we balance spending it all with not running out too soon?
Great question, Yolanda. I would think that this is a very popular question for people that don't have kids and don't have heirs. One of the things that I have noticed with my career in financial services is nobody really dies precisely with $1 in their estate, Doug.
A little more, a little less.
A little more, a little less. And there's no magic wand to do this. One of the things that I've noticed with your question, Yolanda, is you said at the last part that you're afraid of running out of money, but you still want to enjoy your money. What I would do is try to instill some confidence in what you're trying to do and develop a strategy. And there's some different ways to do that. Doug, the strategy is going to depend on Yolanda's lifestyle and her longevity. Mm-hmm. So the first thing that I would do if I met Yolanda is I would do a family tree.
Right.
I would see how long her family lives. Mm-hmm. And there's some actual techniques that we do. Now, the lifestyle is going to depend on her needs, wants, and wishes.
Right.
What her and her husband are going to spend money on in retirement. One of the things that we have to factor in, inflation, the prices of things are going up. Their healthcare situation, that's always a big wrench in the financial plan, the retirement plan, especially when you're trying to spend down money. One of the things that we do, Roger, that we talked about a lot is, you remember the old financial planning software that we used? It had people living to age 100. Now there's software where people are living to age 120, a lot longer than that. So, Yolanda, that is where a financial plan comes in, because really 33% of people over the age of 65 now, Doug, are living to the age of 90, believe it or not. So, Yolanda, another thing that we could do is what Elias talked about. You develop a bucket strategy, especially when you're looking at spending down your assets. You have a spend down strategy. You look at the long-term tax situation. How many times, guys, do we get the telephone call from a customer, hey, I need some money out. What's the best place to take it out of? How many calls do you get each week from customers like that?
Taking money out?
Yeah.
All the time.
All the time. So we have a strategy in place. It's called US. If Yolanda doesn't have a strategy,
that's a good strategy.
She would have no idea how to spend these assets down. And really, I would think that it's progress, not perfection, Yolanda. There's no one great way. You need to develop a spend down strategy to make sure that covers your fear of not running out of money in retirement, you need a spend down strategy.
Yeah, one of the cool things that you do is you do stress tests of these financial plans, and it's something that the software does when you figure everything in there. Because again, that's one of the huge fears that people have is outliving their retirement.
I'm glad that you mentioned that, Doug, because a traditional financial planning office is going to have some risk tolerance questionnaires. If you're in the middle of a bull market, the risk tolerance questionnaires are all aggressive.
Yeah.
Everybody's made money the last 3 years. Sure, I'm aggressive. Everybody's beating their chest. We do have the analysis that actually measures the risk that people are taking, which includes the worst case scenario over the next 6 months. Once you show them that number and you actually give them a number between 0 and 95, how much risk that they're taking. It reminds me of a blood pressure rating or how much blood sugar is in your blood. And people can actually identify and measure, am I that person?
Yeah.
I'm taking this much risk. Am I that person that is in my portfolio right now? So that's a great question, Doug.
Exactly. Yolanda, again, for you, premieriwm.com and the 10 critical steps to take before retirement. Just download that. One of a number of downloadable things there. You also click on through and see that Roger and Elias have a video blog or a vlog, if you will, podcast. It's called Behind the Wealth. Lots of different ways that you can get information to educate yourself, because for so much of this, it comes down to education and inspiration. That's what Premier Investments in Wealth Management does so well. They educate and they inspire people to figure out what to do with their retirement. It's one of the first things that they ask. What does my first year of retirement look like? When so many people are kind of wandering and feeling their way through. It's kind of like, reminds me, Roger, of when I was a junior in high school, didn't have any clue. I had, my sister was a nurse. My oldest brother went to college. I had no clue what I wanted to do with my life. And I didn't know that 2 years later, I was supposed to be enrolled in college. There's a lot of people who they're thinking, okay, I'm planning on maybe retired at 65, but there's a lot of people, you may plan on retiring at 65, but Mother Nature retires you early.
Only 6% of people say they're going to retire before 60. 26% of people do. So I think that's a good thing to keep in the back of your mind. Plan an earlier date than you believe. Likely is a better reflection of what will happen.
Gotcha. PremierIWM.com or call for your appointment, 800-383-6590. Roger David has made it past 65. He's 68 and he is retired. He says he's got about $2 million in his IRA. He wants to know, should I be taking out more money now to lower my tax liability for RMDs? We're talking about those again before I turn 73, or just wait until I'm RMD age?
I would tell David that's a great question. It's one we get a lot, and it has a lot of moving parts. The short answer is that being proactive in taking withdrawals or doing Roth conversions may be beneficial. And I think being proactive sooner than 68 is likely even more beneficial. RMD in general, we talked about it earlier in the show, is when you have to take money out. At 73, it's about 4%. It's not quite, but let's just call it 4%. So right now, David is going to have to take out around $80,000 a year. The problem is, if his IRA is still growing, he's compounding the problem, because when it goes to 2.5 million, now he has to take 100. So one of the things we do with individuals is we'll sit down, we'll use our tax planning software, see what tax brackets they fall in, and then we may do a conversion or a distribution to start to draw down the IRA balance. Let's assume David had all of his money in the S&P 500 this year.
Oh.
If he did, he's made over 200,000. That's why I think being proactive sooner rather than later is better. There's years you won't want to take out 200,000. It adds a whole nother set of scenarios into retirement planning. There's something called the IRMA tax, which if you make over $206,000, requires you to pay more for your Medicare.
Oh,
There are a lot of moving parts to this question.
okay.
I believe this is why we encourage people to have multiple buckets of money like Elias has talked about in the past. Roth, taxable, tax deferred. That way it's giving us choice. And I understand why a 68-year-old would have $2 million in an IRA. A Roth IRA didn't even come out until 1998, so it likely wasn't much of an option for most of his nest egg. The other thing you can think about doing are Roth conversions. And I work with this on a lot of people. If you're making $225,000, that's where you're always going to be in retirement. It might make sense to be converting larger chunks of money, getting them into a tax-free space,
Yeah.
and starting to draw down this $2 million. And I know David's 68. You can start this at 60 and 58 and 55. You can start doing Roth conversions at any time. And the sooner you start to tackle this problem, likely the better off you will be.
Okay. It makes sense. If you go to premieriwm.com, they've got the Investor's Guide series, and there's information, a lot of these things here. Tax strategies, charitable giving strategies, Roth strategies, Rothification. Encourage you to go to premieriwm.com because that can help you take the bull by the horns, so to speak. And don't let time run over you. You can take control of time, in essence, as far as that goes, whether you're retired like David or whether you are not. Jonas, question from Patty for you. My adult kids are trying to buy their first home, but prices and rates are crazy. What advice do you give young buyers today? Thanks, Mom, for wanting to look after the kids, by the way. That's awfully nice.
Thanks, Patty. This is a great question. I love this question. This is a question that really hits home. We have a 17-year-old and a 20-year-old at the Everett household, Doug, that we're looking at this exact situation with high rates and higher local home prices. How in the world are we going to get our kids into some type of a starter home? One of the things I would recommend, Patty, that you look at when you're looking at houses for your kid, you're going to want your kid to have a house with a great foundation, right, Doug?
Yeah.
A fantastic, a very strong house, very well-built house.
Mm-hmm. Good bones.
One of the things that you can focus on, Patty, one of the things that you can control, you can't control the timing of the real estate market, but what you can control is the foundation that you have in your personal finances right now. So you look at what you have in savings, what type of credit is your kid going to have, and really, what type of readiness are you going to be able to have when it comes to maybe finding a place, a starter home for your kid? You look at having the financial readiness, the flexibility, a couple of figures here, depending on how much your child makes, maybe 30% of their income, Doug, it should be going towards mortgage payments.
Okay.
Once you're looking at shopping around different houses, you're actually, and I love how Roger talks about this too, it's not just the down payment and being able to afford to slide into the house. That's the first year expenses. We try to get customers that are looking at real estate purchases to think about the 5 and the 7 year expenses when they purchase real estate.
Mm-hmm.
A great rule of thumb is if you look at the expenses on a house on top of the mortgage that you're going to have, Doug, is what we call the 1% rule. If you're looking at a $200,000 house, you're at least going to have $2,000 to $3,000 a year just in expenses oozing out on top of the mortgage and the taxes and everything else. Then we're going to talk about the fixer-upper houses.
Mm-hmm.
Are you ready, Doug?
10.
10 to 13,000 in little old Iowa.
Yeah.
And that is very on the low end when you have somebody like Elias that knows what they're doing and will do you a favor. So again, focus on readiness, not timing. build a great foundation, 3 to 6 months in emergency funds, pre-approved, some type of a pre-approval letter from a bank, and shop around lenders. And again, don't worry about the timing. Go ahead and focus on readiness.
Yeah, make sure you don't bite off more than you can chew. Get a professional involved, like a realtor. You can check through the Realtors Association and things like that. Also at Premier Investments and Wealth Management website, premieriwm.com. This is what you get from Premier Investments and Wealth Management. Really forward-looking professional ideas like this. premieriwm.com. Make your appointment online or call today to make that appointment at 800-383-6590. Premier Investments and Wealth Management named Forbes 2025 Best in State Wealth Management Team. Heading over to you, Elias, with this next question from Marcus, who says, my 401k plan doesn't offer a match. Should I keep contributing to it or save money elsewhere? This is interesting. I had, for 2 solid years, my employer did not contribute.
For 2 years?
For 2 years. And I kept contributing. You know what happened? I've doubled my 401k in
Good
that
for
same
you.
2-year period because I was like, fine, if they're not going to do it, I'm going to put in what they were supposed to put in.
So you're happy?
Was that
Oh,
during,
dude, I'm so happy.
what did they stop the match?
No, they just stopped.
During COVID or after?
It was both.
A lot of companies did
Yeah,
around
it was during
then.
COVID, but then it was afterwards too.
And now is the match back?
The match is back. And I kept my money up there. So,
And you kept your contributions the same?
yep, my elevated level.
Gold star for Doug. Doug gets a
you
gold star
guys-
for all of those decisions.
Is he your customer, Jonas?
He is my customer.
So gold star for you.
Why did you decide to do that, Doug? You could have taken this negative situation and turned it very negative and just stopped your contributions. What made you decide to go ahead and plug away?
Jonas held him down and said, you're going to keep saving your money.
Well, besides that, I'm a strong man.
Literally, it was one of these things where it's like, you know what? Nobody's going to do it for me. That's what it came down to. Nobody's going to do this for you. You've got to do it and make sure that it gets done. And really, it came down for me is like, I've got to get to the point where I had that same amount of money that I had before because I liked the way that it was growing. So, yay. Thanks, guys.
The match, it's a feature of the 401k plan. The real benefit to 401k is the payroll deduction. Here's what that does for an investor. It builds great investor behavior, which is why you get your gold star.
Thank you.
For great investor behavior. All you're really doing is you're making regular and consistent savings habits and investments. There's another word for it, dollar cost averaging. And if all of that is set up automatic, you're also stopping yourself from trying to time the market. The money goes in, it gets invested. So the match is a feature that helps support the other savings habits. There's a few other things to consider before you think about going elsewhere with the money. There's higher contribution limits in the company-sponsored plans. So if you're thinking, well, they're not going to give me a match, so I'm going to go start an IRA account, your plan at work is going to have a higher contribution limit. 401ks are $23,500, and then you get the catch-up contribution when you're 50 or older, which is 70. That extra catch-up is another $7,500 that you can contribute. So with the higher contribution limits in the 401k, it's still a good option for investors. IRAs, individual retirement accounts, have much lower contribution limits than that of the 401k. $7,000 if you're under 50, $8,000 if you are 50 or older. Different account types can provide some diversification. The main point I want to make with my answer on this is not investing in the company plan that's being offered to you just because there's not a match. That's not a good reason to not save your money and build your wealth. What'd you say earlier? No one was going to do it for me.
Yeah, nobody's going to do it for me. Yeah.
Right, exactly. And that's really retirement in America has shifted from pensions too.
Oh.
No one's going to do it for you. You
Yeah.
have to save your own money and build up these accounts. So the short answer, yes, you should take advantage of your company sponsored plan, regardless of whether it has a match or not.
Right.
The match is a feature. It's not the main benefit. The main benefit is the successful investor behavior you're going to participate in over time by paying yourself first, being regular and consistent with your contributions.
It's easier to do it payroll deduct. I mean, that psychologically for people, it's way easier.
Right.
They don't even know that money was there.
You know why, though?
If you put it into the bank account, think.
Mhm.
You get $300 that goes into a 401k. You never saw it, never saw it in your paycheck. Where you get $300 that's deposited into your bank account, and then it goes to your whatever, Roth IRA traditional. People don't view the 300 as an investment. They perceive it as an expense, which an expense has a negative connotation. They put it into their budget, so that's a budget expense. They don't see it as, oh, this is an investment. And I believe that's one of the reasons the 401k has been so successful. There's no negative connotation associated with the expense of it.
Yeah. And the more moving parts you have, something more that can break down. So something may break down because if you have to push that button from your bank account to the investment account, that you can break it. You know, either you forget where the button is or you just don't want to press the button or however you work it.
I have the greatest example of this. I really do. So I have a individual that I met. He has dollar cost averaged into an asset class that was very speculative in nature over the last 15 years. He's a very, 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 very wealthy person because of this. Every paycheck, he put $200 into this asset class. That's it. If he wouldn't have put the $200 automatically from his paycheck into this account where he bought this asset class, there's no way he would have stuck with it.
Yeah.
Because it's so volatile. Eventually he'd have been like, I'm going to wait for a better time. It's at all-time highs. I think I want to cash in. He literally has just stuck with it for, it's not quite 15 years. I think it's about 13 years he's been doing it. And I asked him, I said, how did you do this? He said, well, I just take $200 out of my paycheck. And coincidentally enough, he's been super successful in his company's 401k as well because of that same strategy.
So it's not like that's his only investment. He's got other investments as well. That's part of his financial plan.
Yeah, he made sure of that was his, what I would call risk on or his discretionary money that if it was worth zero, he didn't care. He took care of his 401k and other retirement obligations. In fact, he probably has more money in his 401k than most of the people that we work with.
Yeah.
Mostly because he's been really, really disciplined to do it from the time he was 22 years old, and he doesn't have a high-paying job. It's a good job, but he's not some big executive. He's just maxing it out for a very long time.
Marcus, thank you very much for that question. If you are like Marcus, you have a question about something like this, get in touch with them at premieriwm.com, and they'll answer it in a future show. Just hit the contact us and answer this. Typically type in there your question. They'll answer it on one of the future shows. Again, premieriwm.com. You can also call and get a question inserted as well, 800-383-6590. Doug Wagner along with Elias Randel, Jonas Everett, and Roger Abel, who gets this question from Mitch. I inherited $180,000 from my mom. What's the best way to allocate it so it just doesn't sit in the bank?
Good question. We get it a lot. The first thing I tell people to do, take a breath, wait about 90 days before you do anything. After that, we need to just take a very good holistic look at your overall financial picture. And there's 4 steps to doing this, or 4 parts of it. The first step is we need to put together a clear plan. What is a clear plan? What are our goals, our priorities? Let's get organized. So first step, let's get a plan together. I always like to address short-term priorities first. And what I mean by short-term priorities, do we have an emergency fund established? If we don't have the emergency fund 3 to 6 months, that's the first thing you should establish. Once established, let's take a look. What is the high interest rate or consumer debt outside of our mortgage that we have? I'd like to attack that next. So if you have a car payment, if you have a credit card, if you have a buy now, pay later, which might not even have an interest rate. If you have a buy now, pay later, let's pay that off. So once we've established emergency fund, we've paid off the debt, then we can put some money to work. And I think this is where people miss it when I say put the money to work. If Mitch already has emergency fund, no debt, he's probably thinking, I'm going to tell him to go invest $180,000. That's not necessarily what I'm going to say. It comes back to having a plan. If we put a financial plan together and Mitch is already on track for retirement, his savings rate is right, this may be a situation where we go to the fourth step and tell him to go enjoy some of it.
Okay.
Because most inheritances, they all get enjoyed. They don't get saved or pay off debt like they get enjoyed in 18 months. But if you are on track for retirement, this will give yourself permission to go enjoy it and not put yourself at peril. If you want to invest it all, that's great. But at the end of the day, those 4 steps, if you just execute those 4 steps, you'll make a very good money decision with the $180,000 versus what most people do. And the windfall's gone in 18 months and it probably went to a car or a boat or
both,
failed business or both, whatever it went to. That's the average that inheritance lasts in America today.
You know what? If you go to premieriwm.com, you can make an appointment online by just clicking through and making an appointment. You can also click Get Started, answer a few questions. They'll provide for you a free 1-page Premier Vision document and a free no obligation consultation to go with that. They'll sit down with you and they'll find out a little bit more about how you want to invest, what your risk tolerance is and what you see your future as. Are you ready for retirement? You can find out by checking with my friends at Premier Investments and Wealth Management, premieriwm.com or 800-383-6590. Named to Forbes 2025 Best in State Wealth Management Team at Premier Investments and Wealth Management. All right, Jonas, going to wrap up with you. Jason asks, I keep hearing that time in the market matters more than timing the market, but what does that really mean for someone close to retirement? And I know you love these sort of riddles, these word games.
I do love these. Great question, Jason. To put it simply, time in the market means that you stay invested through market cycles, Doug, so you don't miss growth opportunities. So we talk about this a lot, the speed of the markets. Roger and I talked about the drops in the stock market. The average drop per year in the stock market is 13%. If you're trying to figure out the best time to get in and out, that would be very difficult. You might want to leave that to some type of a day trader. If you have a long-term portfolio and you trust it and you're confident with that portfolio, it's going to guide you through these market fluctuations. And there's been some great examples on this show, guys. Jason, I hope that you were taking notes because Roger and Elias have some very successful customers that have never tried to time the market. They have their portfolios navigated to where they can really guide themselves through these market fluctuations. Now, retirement's a different game changer, Doug. Usually in retirement, you're done buying into investments. That's where what we talk about, what Elias hit on, these market fluctuations can be protected by some type of a bucket strategy.
Okay.
You're done putting into your 401k. You might be done doing your Roth IRA contributions because you don't have any wage income. Well, now we have a bucket strategy in place, and that's going to help you stay invested longer term. Bucket number 3, guide you through these market fluctuations. And one of my favorite callers from the AM 600 show, he always called in, and the first thing he said was, just tell the customers not to, not to miss the best 50 days in the market. And we have a guide, we have a page called The Best 50 Days in the Market. If you miss these best 50 days. These are recovery days after the market drops. If some or all of your portfolio misses these recovery days, Doug, your long-term rate of return goes down significantly by large percentage points. And like you mentioned earlier about your 401k, how it's gone up the last 4 years. One of the things that I've noticed with people is that they're trusting their portfolios enough to enjoy those recovery years. And again, so Jason, to answer your question, to put it simply, time in the market means you stay invested over market fluctuations, market cycles, so you don't miss the growth opportunities that you really need.
Yeah, that's a good, concise way of putting it. Getting invested, staying invested. And when you're in there, I mean, obviously, every year you sit down with the customers and clients you have at Premier Investments to go over what they're doing. It's not just a matter of set it and forget it. That's on the front end, coming out on a regular basis, whether it's out of your paycheck to a 401k or to an IRA or to a Roth IRA, whatever you want. There's a guide that they have to market volatility at Premier Investments in Wealth Management as well. And it's another really good read. If you've not done that up to this point, I highly encourage you to do it because, Jason, it's not about market timing. It's about making good tea. You just put that tea bag and just let it sit.
It's about time in the market, Doug.
Exactly. You know what? The folks at Premier Investments in Wealth Management, they have an entire staff, not just the three folks that are on this show with me on a regular basis, but there's an entire staff that they have here that takes care of the needs that you have from the back office all the way to the front office. And it really is one of those full service things. Get in touch with them at premieriwm.com and find out a little bit more about what they do. It's philosophy. You're not just interviewing them, though. They're going to be interviewing you, because if you've got this idea that you just want to throw all your money at a single stock and that's going to be your retirement fund, it may not be the best match for my friends at Premier Investments and Wealth Management, because they're about the haystacks, not the needles, right?
Absolutely.
Haystacks. You guys said that. The haystacks, it's not me saying it, it's them. Get in touch with them today and build more haystacks. They will love helping you build haystacks. PremierIWM.com or the phone number, 800-383-6590. For the Big Coon, or Roger Abel, for Jonas Everett, and for Elias Randel, my name's Doug Wagner. Thank you for joining us. We'll see you again soon.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Contributions to a traditional IRA may be tax deductible in the contribution year, with current income tax due at withdrawal. Withdrawals prior to age 59.5 may result in a 10% IRS penalty tax in addition to current income tax. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Forbes' Best in State Wealth Management Teams ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firm. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.